Hey everyone, I'm Jeremy Szafron. This is Kitco News. Be sure to hit the subscribe button. Now, on today's show, we're taking a closer look at the action in the precious metals market as gold edges higher, but volatility is notably shrinking. As we approach key inflation data releases this week, all eyes are on whether or not gold can break through that resistance of 2550 or if the market will face another pullback. At the same time, silver is stuck between $28 and $29. It's closely tied to China's economic uncertainties. Now, the Federal Reserve's rate cut decisions loom large, with the market anticipating a significant move. But the question is, will it be enough to shake up the metals market? To break this all down, I'm joined by Phil Streible from Blue Line Ventures. Welcome back to the show, Phil.
Yeah, thanks for having me on, Jeremy.
Okay, let's start with gold. I mean, you've noted that gold volatility is kind of compressed significantly over the past month. I mean, with CPI, PPI data coming out this week, could this data be the catalyst to push it over that 2550 mark?
Yeah, well, it seems like some of the economic data we've seen recently, especially with inflation, as it starts to kind of grind its way lower, we see less volatility in the number, and that attributes to the volatility that we've seen come out of the gold market. It seemed like, well, you rewind about a month ago, that inflation data and other economic data was much more important at that time and really had shifted the direction of the possibility of the Fed cutting 25 or 50 basis points. So that's the reason why, if you go back to August 5th, the average shoe range on gold was about $44 an ounce. And you come into today, it's only about $33 an ounce. And it seems quite complacent at the moment. So we'll have to really see if this data has any kind of legs to it. But I really think that the labor data is probably the most important on Thursday with the initial claims. And then obviously, what's going to happen with the Fed on September 18th.
Yeah, given how markets are digesting this inflation data, it seems like we have new stuff coming at us every day. Could we just as easily see gold pull back if inflation surprises, obviously keeping volatility subdued maybe a little longer?
Well, if you look at like the support level on gold and you go back like on a chart of like a week or 2 weeks, you could see that there's just a great deal of complacency between 2506. That was about the August low. And then also we've cycled up. We get up to 2550, 2560, and it seems like traders are eager to take profits there. The open interest, the amount of traders that are involved with this market has accelerated drastically higher. And I think that they're just kind of selling those small rips, buying these dips. And I really think that the line in the sand for the gold market right now is 2,500. You don't want to see a trade below there, and you surely don't want to see a trade below about 2,482, because if it breaks below there, it's going to go back into a neutral trend, and things might have changed at that point.
Mm-hmm. It's interesting, especially watching it now with the latest news out of China. Speaking of which, I mean, silver has struggled within that $28, $29 range. It feels like we're always talking silver, trying to just get out from under its feet here. You've highlighted its sensitivity to China's economy. Should traders continue to watch China's recovery closely? What are your thoughts here?
Yeah, you definitely got to watch it. I mean, the inflation data that they came out was quite deflationary, and it's never good when you start seeing them blowing up their own buildings because the property sector is just in dire straits. The builders are all going under and things like that. They've made a few attempts to stimulate their economy, allowing people to refinance. They've also, been playing around with their debt market, trying to adjust interest rates and things like that. But unless they get some real clear stimulus, or they really turn the page as far as, having some economic recovery, I mean, silver, can you see silver rallying without the world's second largest economy participating? And I really don't think so. And I think that's why, you're seeing the gold silver ratio travel up to about 89. You could also see that it's not just silver. If you look at other China dependent commodities, things like soybeans, things like crude oil, copper, all these products have had significant headwinds just recently. They're all down over 1% as of this recording, and it's very problematic. So you really need two things when silver takes off. You need gold futures up, near these all-time highs and things like that. And you need to see China participate in the recovery. And that's how you can get $35, $40, $45, $50 silver.
Yeah, it's been so interesting watching just, seeing them say that, okay, we've maybe paused for 4 months in essential buying too. And obviously we'll be continuing to watch that. Looking to the state side, I mean, obviously the Federal Reserve's next meeting is approaching. Rate cuts are heavily anticipated. Yeah, you've described this as irrelevant for market performance. Explain why rate cuts won't drive the gold and metals market as much as traders expect.
Okay, so the big question that everyone has is it 25 or 50 basis points? I think that the Fed is only going to do 25 basis points. They only do 50 when it's a panic or a rescue, and we're not at that kind of stage in the economy whatsoever. So at Jackson Hole, Jerome Powell stated that the time has come for the Fed policy to adjust. So that definitely opens the door for that interest rate cut. The question is if you're a gold trader and you're a gold bull, is what pace will the Fed use to reach its neutral rate? And then what is that neutral rate? What gold bulls want to see is they want to see less aggressive action by the Fed. So the journey that you're on takes longer to reach. What you want to see in a perfect world, Fed cuts 25 basis points. Then guess what? They cut 25 and 25 and 25, and it just goes on, and it's ... of them cutting until they reach their neutral rate. And that's how gold futures continue to go up. I've traded gold actively from a futures side and really micromanage the contract because I'm a very data-driven, economically driven person. And I see that almost every time when the Fed gets about halfway done or 3/4 away through the cutting cycle, that is when gold had peaked because now it's expecting tighter conditions. The market, the situation is changing in the economy, things like that. Things might be heating up because the Fed had instituted almost like a put option. We had the Bernanke put for a while. They'll start doing quantitative easing. Markets start to turn, and they turn about 3 to 6 months faster than what the Fed does.
Mm-hmm. I mean, unpack that a little bit more, like in terms of if we see, I know I was talking to an analyst yesterday, they said, okay, we'll probably see 25 basis points being cut right off the top. Maybe the next one, 50, just to go a little faster because it's after the election. Could a larger than expected cut still trigger short-term reactions in both the equity and metals market?
It could, but the problem is if you cut too dramatic and it's almost perceived as like a one and done, or the Fed will start pausing after that interest rate cut to let the market digest it. That's what gold futures don't like in U.S. equity futures. And the reality is that U.S. equities have not performed great after that first interest rate cut in the cycle because it's two problems. One, people who have been getting 5% in their money market accounts and things like that, that's all of a sudden about to start ratcheting down. And a lot of these people rely on that for monthly income. They've had it for, they've had the highest yielding accounts in 2 decades, and they become comfortable that now all of a sudden you take that away from them, they start to tighten up the belt and the economy tightens as well. And then people that make loans, these businesses and things like that, they start to go, hey, the Fed's cutting rates. That means there's something wrong with the economy. We need to tighten up our loan restrictions and things like that. So the economy generally starts to contract a bit on that. Now on gold, if you go back to 1980 and you look at the first interest rate cut after a hiking cycle, gold futures on average have rallied 6% within the first 30 days of that interest rate cut. So I think that being long gold, yes, is appropriate there. But if we get too far ahead of ourselves and the gold prices start to factor in 50 basis points and you only get 25, you're setting yourself up for a slight disappointment.
Yeah, well said. And obviously yesterday, last week we saw that S&P take a huge hit, some questioning whether the AI trade was over. Buyers seem to be buying the dip. Has anything surprised you here? It's pretty stable.
We sold off pretty harshly on Friday. That was a mass liquidation in the market. The fact that there was no data that came out yesterday, no news was perceived as good news. We got a small relief rally. Today we've got mixed results, and the S&P 500 ran into some resistance at 5,500. My line in the sand and the trend system that I use had triggered a bearish trend in the S&P 500 on Friday. Where my stop out point would be, kind of where I get tapped on the shoulder, would be if we start to see a series of closes over 5,500. We ultimately trade back above the 50-day moving average at 55, 53. At that point in time, I probably have to trim positions down and start to really lighten up and then look to go back to the upside.
Yeah, Phil, you talk quite a bit about oil, and I mean, it's something we have to look at. I mean, we got tensions in the Middle East, the ongoing supply outage in Libya, and Storm Francine in the Gulf of Mexico. Brent crude has fallen below that $70 per barrel mark. I mean, it's been volatile ahead of the presidential debate as well. You mentioned possible shifts in policy stances. What's your take on how green energy and maybe domestic production discussions might impact the oil market?
Well, I mean, Donald Trump was very convinced that he can get oil prices between like $50 and $65. So, the average patron doesn't feel that pressure at the pump. Under the previous administration, we did see, or the current administration, we have seen, $80, $90 crude oil. And it seems to be crude oil is one of the biggest drivers of inflation, and it really impacts the most because it's just shocking when you're filling up your gas tank. So I think that these types of shifts could really make some dramatic, price fluctuation, at least more stabilization. I also think that Middle East tensions might come down a bit under Donald Trump because of his hard stance. So on Iran and things like that. So prices may remain at these lower levels. But when you start to see, if you're involved with any commodity and you speculate in any commodity and you have a directional bias, you think crude oil prices are going up because of Middle East tensions, whatever it is. And all these different things, some of the things you just listed, come out like Libya and geopolitical risks and things like that, and the price can't rally, that is a big that's a smoking gun that you really need to not be long crude oil futures in this type of environment. And especially when you have an economic slowdown, people tend to drive less, they spend less, they're doing things like that. They're very cost aware of what they're doing.
Mm-hmm. Yeah, well said. Okay, before I let you go, obviously we have the CPI numbers out. We got a presidential debate that hasn't happened during the time that we've aired this, at least. So I'm kind of curious here. What's the week expect? What's your outlook here?
On the presidential debate, get the popcorn
on the presidential
ready,
debate.
get the popcorn ready and sit back and watch. So it's always entertaining to see some of these people, chatting at the mic. So, but I just don't see that the CPI data is going to be that big of a mover and shaker. I definitely like the gold market. I like buying corrections, small corrections, and the corrections have been pretty shallow. Again, my line in the sand's 2482 on the silver market because of that correlation between China. Some of these other asset classes are really weakening up quite a bit. I suggest something easy for a person to do would be look at like the 200 moving average, which is about 27.45 on silver. I think that would be a place to start to stick your toe in the water.
Yeah, well said. Phil Streible from Blue Ventures joining us today to break it all down. Okay, I'll get the popcorn ready and we'll have you on in a couple of weeks here and we can see what the heck is going on.
Thanks, I appreciate that.
Have a good one.
Thank you.
I'm Jeremy Szafron for all of us here at Kitco News. As we just mentioned, of course, we'll have full coverage of the first presidential debate as well as CPI tomorrow. It's going to be an interesting day. Stay with us here at Kitco News. I'm Jeremy Szafron for all of us here. See you next time.